Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. Interest rates, inflation, and crypto. Oh my, it all ties together. How does it all work? I was asked last night on my AMA by one of my Patreons about how the interest rates work and how it all ties together. So it's complicated. It's really complicated. I will share a lot today about how I do a lot of this research, how I try to stay on top of these things. It's a lot of work. It really is. But I look a lot of different people, a lot of different sources that I trust, not just crypto, but also the economy, also some, I mix a lot of different things together. But let me first explain how interest rates affect the bond market. That's probably the first thing we need to talk about. So Lynette Zhang over at ITM Trading, she's a gold bug. She does great wealth planning. She's one person I follow. I'll be sharing, I'll be pointing out her YouTube channel in a moment. But first, I wanted to just show you an illustration that I thought she did a great job with this, which is that this is an example of the bond market. So what I'm going to show is like how this relates to a bond. So I'm going to hold a bond right here in the middle and hold it as level as I can. So this is the issue date of a bond. Okay. On one corner is the yield and the other corner is the price. As the yield or the interest rate goes up, the price goes down. And also this is a factor of time. So bonds have a length of time. They could be 1 year, 10 year, 20 year, 30-year bonds. As the price goes up, the yield or interest rate just goes down because, okay, so let's just say that we have $1,000 bond. It's a 1-year bond and the yield is going to be 11%. So I'm going to make the yield very high. The price is going to be about $900 because a year later, it's going to be at $1,000 when you cash it in. If the yield is going to be 5%, well, the price is going to be about $950 now. So the price goes down when the interest rate goes down, the price will go up. The price goes up when the interest rate goes down because, again, less interest. So it's going to cost more at the beginning because you're not getting as much yield. So if the interest rates go down, that's this side, and I'm in reverse on the camera, so hold on. So if the interest rates go negative, the price goes up with a bond and no one wants to buy it. So you're basically when you're at a negative interest rate. So if the interest rates are flat, you're paying $1,000 for a bond that at maturity gives you $1,000. If it's at 1%, so I'm going to make it 1%, a little bit positive, I'm going to pay about $990 to get $1,000 a year later. Doesn't make much sense. Now, what's happening? So that's how interest rates and yields and price of the bond market all works. So again, this illustration one more time, and now I'm going to show negative interest. So that's this side. If the interest is negative below the level, now the price has to go up. That's not good. Okay. So that means that people are basically, you're paying money to get less money back in the future. Now, why would anyone do that? There are bond markets. There are things in the marketplace that you have to buy bonds. We're talking about pension funds, 401ks, things that have maturity that, like, by law or by decree or wherever it's written, you have to have so much exposure to bonds. So they're going to chase the best bond market, the best interest rate. That's why the US wants to have a positive number, because most of the bonds are negative across the globe. But the actual interest rate, the real interest rate, is the difference between the interest rate and the inflation rate. So if inflation is running at 7%, which is what they've announced, which we all know is a fake number, it's actually higher, and interest rates are about 2%, give or take, the real interest rate is the difference. So it's about -5%. You're losing 5% of your purchasing power a year based on the official numbers, and we know it's actually worse. So that's because when they calculate the CPI, the consumer pricing index, they don't include energy, they don't include food, certain things that are inflating way out of control, they don't include. So the energy, last I checked, was like 50%. I didn't see the January numbers, but you get the idea. You're paying way more for your everyday costs. and your purchasing power is going away. So that's the evidence that the fiat system is starting to crumble, because their nominal 2% that they want to inflate every year is now way out of control and probably double digit, if not more. Go to shadowstats.com to see some of the real numbers. We're probably, I think, and this is just the US. The US is double digit for sure. Other countries are like 30, 40, 50%. It's getting way out of control. So back to the interest rates and back to the Fed. What are they doing, and why do people care so much? So now you got to go to the economy and what people really look at. There are four major interest rate bonds. There's 30-year mortgages, 20-year mortgages, 10-year mortgages, and 2-year mortgages. The 30-year mortgage rate, when that, and it's length of time. So that's the length of maturity. So normally that the lowest interest rate is the 2-year or the 1-year. So there's 1, 2, 5, 10, 12, but most people look at 2, 10, 20, and 30. Normally 30% gives the most interest because you're locking your money up for the most amount of time. Think about loaning out. If you give a friend $100, you're going to want more money over in the future, the longer he keeps it. So 30 years should be higher than 20, 20 should be higher than 10, 10 should be higher than 2, and so on. Well, what we're starting to see is inversion. Inversion is when right now, the 20-year rate is actually paying more than the 30-year rate. That is an indicator that recession could be coming. What people are really looking at is the 2 and the 10. The 10 is bad, and I'm going to show that chart in a couple minutes. The 10, and when the 2 and the 10 invert, and we're getting close to that. The last time that happened was 2018. About 18 months later is usually when a recession hits. 2018 led to 2020. We know what happened in March 2020, 2 years ago. The economy imploded. So, and we can all discuss in another channel at another time why, but the truth of the matter is all the markets basically imploded in March of 2020. So now we've talked about real inflation rates. So let's tie this all together to the economy, and it's multiple steps. So I mentioned earlier that the real inflation rate, we're really at negative rates right now, because the inflation rate of 1 to 2% in several markets is way below the 7%. So the difference is -5, -6% at least. So that's negative inflation. That means lower yield for capital markets, which leads to lower liquidity in the same markets, which is what companies all care about, because they also issue bonds. Companies need to issue bonds and have them sold into the marketplace so that they can operate their business. If the real buying power is negative, the real yield on these bonds that companies are issuing are negative, then they have a hard time selling their bonds, and they can't get liquidity, they can't get capital to run their businesses, which will lead to businesses doing other things like cutting jobs, which will lead to more recession. So see how it's starting to spin. Like that's how the recession leads to a depression, and we're going to lead to a hyperinflation. So that's how it all ties together. The Federal Reserve, back to that now, they have two real levers to push. One is interest rates, which they really just don't want to do. They said yesterday that there's going to be 4 interest rate hikes this year. Now, the typical rate that they move is 0.25% or 25 basis points. So even if they move it 4 times at 0.25%, that's 1%. If we're running at -5 or higher, 1% is not going to do a thing. It's not going to change any of the things I mentioned already. So the only other tool that they have is what they call quantitative easing or quantitative tightening. That's tightening. So QE or QT. Quantitative easing means that they push money that they print into the marketplace to buy some of these bonds. They're trying to say that they're tapering that, which gets to quantitative tightening. So that's not going to work either. So if there's no marketplace for the bonds, usually the line of last resort is the Federal Reserve buying these bonds back, either through mortgage-backed securities or through corporate bonds, and that's just not happening. So while they said they're hinting at interest rates going up in March, that's just posturing. The markets are trying to figure out what's really going on. They're just saying things for the sake of saying things. They're hinting at the 2 buttons that they can push, but really there's nothing they can do. And the interest rates, the real interest rates of what the Federal Reserve number is 0.2%. It's negligible. So the only thing they can do is raise them to lower them again in the next crisis. But even raising them a point or two won't do it. The last time we had really high interest rates, I will get to that chart in a minute, back in the 70s and 80s, but that really wasn't what was going on to really fix the economy. So to wrap up my notes before I start getting to some charts and to tie this back to crypto, let's see, we were saying that the inflation, the other thing that they're saying two more things. They're saying the inflation rate of 2022 in the second half of the year is going to go down. And this is the Federal Reserve speaking. And they're also saying that inflation is transitory. They don't give any verbiage as to how either thing is true. So again, saber rattling. They're just saying things for the sake of saying things to try to keep the markets calm and keep these plates spinning as long as possible until all the fiat systems and all the central banks just implode. So, and this is even before we hit the real estate market. The real estate market is starting to turn the days of the market for, that's one of the other indicators. The days of the market for housing is getting longer and longer. Prices are starting to dip. Who's buying houses? Not nearly as many as last year. So between that and supply chain issues, there's a whole lot going on. So I'm going to pause there, and then I'm going to start sharing my screen and share a few things from all the different videos I watched yesterday. Did a lot of homework, and then I'll kind of tie it all together into crypto. So more in a minute. All right, now I'm sharing my screen. So let me share a few things to try to tie this into the crypto market. First off, here's my sources, like I always like to share. First was Lark Davis was one. That was one that I watched yesterday. Then another is The Modern Investor. The third is Nobody Special Finance. And the fourth one is ITM Trading or Lynette Zhang. So she's a gold bug. She does great wealth preservation. She's not really a big fan of crypto, but all these things tie together. So let me share some of the things to tie this all together. So first, let's start with Lark. Okay. I'm going to start with Nobody Special Finance because I wanted to share this chart. This chart here is the 10-year yield. All right, much better. So this is the chart of the 10-year Treasury yield. And this red line that he drew indicates when severe issues happen. We had the dot-com bomb in the 95 era. We had the bank crash in 2008. And then we had 2018 where we had a whole lot going on. We had again that inversion, which led to the recession. So this line is the slope of when things start to go bad. When we touch that line in the 10-year rate, it's not good. And we are at 1.85 right now. And this is about 2 to 2.5. So we're really close. So going back in the 70s and 80s, you could see how high the interest rate was. It was like 14-15%. And lots of people were saying that the Fed back then was fixing things, but what really was happening in the 70s and 80s is that there was a transition to the petrodollar. So as we transitioned to the petrodollar, we were able to start lowering the interest rate down, and they would start to raise it, and then bang, something bad would happen, they'd have to lower it again. So that is basically one of their levers. So it's going up. They lowered it again through the 17 to 20 range, and now it's slowly going back up, and it's not looking good because as soon as it's normally something, what Nobody Special tries to say is that whenever this line gets touched or broken, something breaks. So we're getting close to something breaking. So next picture to bring this into crypto. Lark Davis had some really good information to share. First off, the fear and greed index is way, way low. This is from a day ago, basically saying that extreme fear, everybody's worried about what's going on. Normally, when this goes way orange is a good time to get into the market. Just an indicator, not financial advice. Now, other charts to talk about crypto here. And this is a great chart. And Lark says this is basically probably the most important chart in crypto. Now, what this shows is the growth rate of the internet versus the growth rate of crypto. Okay, total crypto users. And now you can see that it's just astronomically going, and the number that Lark was saying for. Okay, so these are interposed. The white line here is the internet. And these are the white dates, so from 92 to 2006. and orange is crypto. So that's why we're here. So in this year alone, we're expected to go up. I think this is in millions. So it's 3.8 million. So we're going to be getting to 1 billion crypto users by 2024. And we are not even at, I think we're in the millions right now. I think we're at I don't know the exact number. It's logarithmic. So we're about 200 to 300 million. So we have about 700 million to be added in the next 3 years. That's a lot of people. And 3.7 billion crypto users in 2030. So there's a lot of adoption yet to still happen. This shows that it's early. Another indicator of how early this is, let me get my head out of the way. So what this is the Bitcoin illiquid supply versus price. So the price of Bitcoin is in the darker color, but this is the illiquid supply. Basically, this says that how many Bitcoin are not available for purchase on the exchanges. Over 14.5, that's 14.5 million. So, and there's about 19 million. So roughly the number is 75% of all Bitcoin are not available on exchanges. So there's not a lot. So what they're trying to do is get more into the marketplace, shake out the paper hands, get the weak hands out, get Bitcoin out there, dump the price so that the powers that be, whoever wants to get in, can buy Bitcoin. Why? Because the Bitcoin inflation rate, this is another important curve. So what this curve shows, this is the number of Bitcoin over time. And we all, for those of you who don't know, Bitcoin is all mined out by the year 2140. But if you look at this chart, we are over 20 million Bitcoin mined by the year 2028, 2029. That's roughly, that's almost 100%. That's roughly about 96, 97, maybe 98% of all Bitcoin will be mined by the year 2029, which means 1 to 2% of all the Bitcoin that's left will go from 2029 to 2140. So the time to accumulate what is currently available is between now and 2029. So, because right now we're at about 18 and we'll be minting about 1 or 2 million more in the next 8 years. So the acquisition time for Bitcoin is now. That's the time to accumulate your crypto. So trying to shake out your hands, they're trying to get into the marketplace, and they're trying to get as much Bitcoin away from you into the whale wallets as possible. So that was a lot said today, but before I go, I just want to ask you, what did you think of this content? Did you like this type of video? I know it was a little longer than usual, but I thought there was so much going on and there was so much discussion. Somebody needed to try to tie it together for you guys and put it in crypto sense. So hodl, that's really my advice. Acquire and hodl as much as you can. If you like this content, leave a comment, like, share, subscribe. Really appreciate that. Helps the algorithm. Give it a thumbs up. Appreciate that too. And of course, if you want to catch more of my content, there's my Patreon. And of course, CryptoConfidential launches next Tuesday. If you haven't joined there yet, you've got a few more days to get on there at the discount code. Drop me a line if you need it. But come the first, the price is the price. And that's where most of my content will be. So with all that said, I'm going to close my drawer in the bureau, say follow the leader, and I'll see you next time. Take care.